Hello there. This is Boom Bust. I'm Amira David filling in for Aaron Aid, and here are the stories we're tracking for you today. Wall Street bonuses are bouncing back, raising 2% in 2014. But how do those bonuses compare to the salary of the average American worker? I'll break down all the numbers coming up. Then Axel Merck is on the show. He'll be talking to us about the European Central Bank's bond buying program and whose pockets stand to gain the biggest boost. And then I'll sit down for a one-on-one with our very own Ed Harrison as we discuss GM's share buyback program and how it could tap into the pockets of taxpayers like you and me. We've got a packed show for you today, lots of news to tackle, so let's get started. Well, it's a great time to be a Wall Street banker. Their pockets are a little bit thicker these days. The average bonus in the securities industry actually rose 2% in 2014 to almost $173,000. And that's the highest it's been since 2007, pre-financial crisis, when the bonus was at about $178,000. At the same time, we're learning that the bonus pool for securities industry employees has grown by 3%, reaching $28.5 billion for the year 2014. The latest numbers are all according to the New York State Comptroller's Office. So to be clear, we're only talking about bonuses paid out to employees in the city of New York. Well, what's so interesting about this is that bankers are seeing this raise despite the fact that Wall Street profits actually fell last year. According to the comptroller, that's partly due to multi-billion-dollar settlements, legal settlements, of course, that these banks had to pay out post-financial crisis. And even that hasn't seemed to faze the industry all that much. So we're talking about a very strong Wall Street. And as you might imagine, it paints a very stark contrast from what the average American is actually making. If you take a look here, you'll see that that gap between 1990 until now, current day, Wall Street bonuses and average salaries has just grown dramatically, grown very divergent. In 2014, the average salary for a U.S. employee was less than $46,000. That's 4 times smaller than what was paid out as a bonus that year. And the chart doesn't even take into account the fact that bankers also receive base salaries. So the question is this a matter of Wall Street employees being more productive than ever before, or are they simply overpaid? We'll address that topic later in today's Big Deal. The European Central Bank began its long-anticipated asset purchase program on Monday, and it's calling the scheme the Public Sector Purchase Program. To get some insight on that, we were joined earlier by Axel Merck. Axel is the president and CIO of Merck Investments. Edward first asked him who exactly stands to gain the most from the quantitative easing, and here's what he had to say.
Well, the only thing that QE really does, it weakens the euro. And the only folks that benefit from a weaker euro are those that are able and ready to export. Germany. Germany is the one country that benefits from it. If you're in Greece or Spain, well, maybe you sell a little bit more olive oil, maybe you get a few more tourists. But the only quote-unquote benefit is really to the folks who know how to export, who are ready. And that's Germany and some other northern European countries.
Now, how do you see QE affecting yields in Europe? I mean, we've got negative yields right across Europe's core countries, including Belgium, which issued a 10-year bond at a yield of 0.50%. And this is a country with government debt to GDP that's north of 100%, right? So how much lower can yields go?
Well, I mean, Draghi said he's willing to pay as little as the deposit rate. Right now, deposit rate, if you park money at the ECB, you're charged 0.2%. So he's willing to drive down the yields to minus 0.2%, which means in Germany, for example, he has to go out more than 3 years to buy anything, and then eventually that's going to go to minus 0.2, and that seems to be where it's to be. And the reason, of course, is that why would you sell your bonds if then when you're left with the cash, you're penalized with that negative interest rate? And so Draghi's logic is, and I think he has a point there, is that if you drive it down to minus 0.2, investors should be willing to sell sufficient amounts so that he can execute his strategy. Keep in mind, though, that the European markets aren't as liquid as U.S. markets, so he has quite a task ahead of himself.
Definitely. And what about periphery yields? They've been falling precipitously. A week ago, Rabobank said that it thinks the spread between the rate where Portugal borrows money for 10 years and the rate which Germany borrows for 10 years will narrow at least 125 basis points. That's 1.25%. That's pretty big, isn't it?
Well, sure. I don't know whether it's going to narrow that much, but right now, I mean, we live in an absurd world here, of course, and the question is where is this going to lead to and what's it going to do, and who benefits from it, you ask initially. I mean, if you think about it, what supposedly QE is supposed to do, it's supposed to jumpstart the European economy, it's supposed to get up inflation expectations, but all the things that are wrong with Europe, be that the lack of structural reform, the impaired banking system. If you take sanctions against Russia, that inhibits growth. I'm not saying I'm for or against them. Those sort of things, none of these things can be fixed with QE. And so the argument Draghi makes is that QE lowers the euro, with that inflation ticks up. Well, good luck with that. I mean, sure, I mean, yes, energy prices are supposed to be going up with that, if that's the sort of inflation you want, but energy prices are down for other reasons. So it's really to weaken the euro, to try to give a hand to the peripheral, because ultimately the logic is that the peripheral needs to get more competitive, and lower wages is one way to get more competitive, but that's politically extremely painful. So he's trying to do that by turning Europe into some sort of banana republic.
Interesting. Now, Axel, let me read a quote for you from Benoit Cœuré, who is a member of the executive board of the ECB. He said in a speech in Frankfurt on Tuesday that, quote, we do want to affect market prices, but we will not suppress the price discovery mechanism. The euro system will ensure a high degree of transparency around its interventions and will closely monitor their impact on market liquidity and collateral availability. What do you make of those comments?
Well, they don't want to, but they clearly do. I mean, they don't do it as badly as the Japanese. The Japanese have destroyed their JGB, their government bond market, and in the Eurozone, at least they only want to buy a certain percentage of each issue, have all kinds of rules. But again, for anybody who's ever dealt in the Eurozone bond market, and we do that as a business, their liquidity isn't that great in the best of times. And now you have a player buying over 60 billion euros a month. That does have an impact. And then clearly, central banks have distorted asset prices throughout the world. They do that with any monetary policy, but specifically in the current environment. Most notably, what they have done is they have taken risk out of the market, perceived risk. Portugal doesn't appear risky anymore, but clearly it still is. And once in a while it blows up, like the Swiss franc. They try to peg it to the euro, and then it blows up. This risk is still there, and the problem is it's not just a European problem. Risk is being taken out of the market everywhere. Investors feel safe in the stock market these days, but the stock market is a risky place. And so all of that can come back with a vengeance. For the time being, of course, the Eurozone bond market is okay, but if you have an exit at the Fed, a lot of these things come back to the surface.
Yeah, and you know, one of the good things, obviously, they're saying is that Eurozone economic growth is getting upgraded everywhere. Do you think that small and medium-sized business will benefit in 2015, though?
Well, we have a cyclical recovery in Europe, and let's not keep. We like to bash Europe for all the things that are wrong there, but of course certain things are priced into the market, just like the U.S. is priced for perfection, and things are certainly not perfect in the U.S. Things are priced to be very horrible in Europe, and things aren't all that horrible in Europe. Now, clearly, if you go to a place like Germany, yes, small and medium-sized enterprises benefit. If you go to a place like Greece, well, Greece, it doesn't matter what the ECB does, and so the idea is, of course, that the weak euro helps everybody, and especially in Germany, there are lots of medium-sized enterprises that do export a lot as well. So from that point of view, yes, they benefit. But really, the best thing you can do is a good long-term policy. You need to have structural reform. You need to allow people to work with reduced regulations. And those are all things that, again, that Draghi is not fixing with his printing press.
Right. Axel, in Austria, we're getting a taste of Europe's new bail-in rules. Basically, the bankrupt bank, Hypo Alpe Adria, was split in two into a so-called good bank and a bad bank called Heta. And now it turns out the bad bank is a really, really bad bank, and that means it's bailing in creditors, including Hypo's home province of Carinthia. Now, the bottom line is Carinthia could declare bankruptcy, but the question is, do you think bail-ins are the way to go in Europe?
Well, clearly, I mean, bad decisions have been made. Let's take a step back here. No matter whether it's the U.S. housing market, whether it's giving loans to Greece, bad mistakes have been made. Somebody has got to pay the price for it somehow. And so for a while, we, quote unquote, socialized the losses by trying to roll it off to taxpayers. If Greece defaults, the ECB is losing $100 billion. That somehow is going to be absorbed by the public at large. And so clearly, a more direct hit of those who have actually loaned money is the right way to go, because you gotta be willing to assume the risk, which means also to willing to absorb the losses. And yes, I mean, if a bankruptcy is part of it, I mean, the real problem with bankruptcy on some of these levels is that there's no well-defined process. But bad things happen, bankruptcies happen, and stressful periods are less stressful when a sound institutional process is in place. That's really where the focus should be, not to protect somebody who has made a bad choice.
Time now for a quick break, but stick around because when we return, we'll talk to economics professor Michael Hudson about Ukraine's beleaguered economy. Plus, in today's big deal, Ed Harrison and I will take a special look at GM's share buyback program and how that's going to affect taxpayers. We'll tell you all about it coming up. And remember, you can see all the segments featured in today's show on YouTube at youtube.com/boom-bust-RT. and on Hulu at hulu.com/boom-bust. And as we go to break, here are the closing numbers at the bell.
I think the shutdown's pathetic, Larry. We shouldn't have to pay taxes then, should we?
Good idea, Jesse.
But have no fear, because the billionaire oligarchs are here.
What if there were a country in which the government operated outside of constitutional rule?
40% of the food that we produce in the country never makes it into our mouths.
How much fallout do you think this is going to create for the CIA?
Do you think this is what's triggering the crisis?
America's the largest economy in the world. It's also the largest debtor nation in the history of the world.
I need to know what to be terrified of. There is nothing scarier than not knowing what to freak out about.
One minute they were working toward the American dream, the next they were just trying to survive the night. It's time for Americans and lawmakers in Washington to wake up and start talking about the real causes of poverty in America.
I'm a fighter. I can take a punch. I live. I learn something every day. I strike when I need to strike.
It's like that.
I prepare. I've earned everything I have. If I fall, I get back up. I won't be underestimated. I'm Erin Aid, and I put the boom into boom bust.
Welcome back to the show. To discuss Ukraine and the International Monetary Fund, Michael Hudson is on the show. Michael is a distinguished research professor of economics at the University of Missouri, Kansas City, and the president of the Institute for the Study of Long-Term Economic Trends. The Ukrainian economy is in a free fall with base interest rates at 30% and inflation at 34.5% through February of 2015. So Edward first asked him to explain the latest numbers, and here's what he had to say.
Well, as you say, it's in a free flow. The kleptocrats are taking all their money and running. They're sending it abroad. The Ukraine is spending, obviously, most of its money on war. People of working age are fleeing the country to avoid the draft. Either they're fleeing eastward into Russia, or they're going west into Poland, hoping to get into the rest of Europe. So Ukraine is emptying out its economy because it's the most corrupt economy in the northern hemisphere, to make a long story short.
Well, now, what about currency reserves? My understanding is that one of the biggest problems for Ukraine is liquidity. They have a paucity of foreign currency reserves to draw on, less than $6 billion, and that makes the situation very serious. Does this weaken Ukraine's bargaining position vis-a-vis the IMF and other creditors?
No, it strengthens it enormously, because it says we're so broke that if we go under, we're going to be a failed state and Russia will take over. So the kleptocrats are purposely emptying out all the money, and now they're going to the West, and they have a wonderful position. They can say, give us all the money, and we promise to sell you all of our land, our raw materials, our real estate, our natural resources, our gas rights. The only way that they can repay their debts is to sell off everything they have to American investors and to European investors. And so by being poor, they say, you see, we have no choice. Give us money and you can rape us.
You know, there are a lot of different ways I'm going to go from here, but let me first ask you, because I'm going to have a few follow-ups here. I've heard a figure of about $40 billion of potential loan amounts from all the potential creditors, with the IMF contributing $17 billion. Where else besides the IMF can Ukraine receive funds?
Well, George Soros has said he'd like to come in and go into partnership with the kleptocrats, and he and them will loot the country in common, splitting the profit. So there's a lot of Western money that can come in to work with the thieves that are running the country.
Now, you know, the IMF is prohibited from making loans to countries at war. That would suggest, to me at least, that the Ukrainian government sees the current ceasefire as a high priority, since they need the funds. Is that right?
Well, Ukraine did promise to stop the war for 24 hours while it gets the loan, and then go right back. But there's an even more serious problem with the IMF. It's not allowed to make loans to countries that are insolvent. As you pointed out at the beginning of the introduction, Ukraine is insolvent. There is no possible way that it can repay the loan except by privatizing and selling off all of its property to foreigners. Now, this is very interesting. If the IMF can't make loans to countries at war, and if it can't make loans to countries that can repay, if there's ever a Ukrainian version of Greece's Syriza party there, they can say, look, this loan was given under illegal pretenses. It is null and void under international law. We don't have to repay a penny. And by the way, we're retaking all of the property that they've given away.
Right. Now, what will the IMF require of Ukraine in order to meet the requirements under an IMF program?
Its directors will have to be taken out for lunch by the U.S. Treasury and the Defense Department and given a lot of free lunches, and promises that when they leave the IMF, they'll have very high-paying jobs on Wall Street.
Well, do you think that despite the hit in the medium term that the IMF could help put the country in a sustainable course, or is this just one big asset strip?
Look, the IMF's job isn't to help countries. It's to empty out countries. It's to impose austerity and to force countries to sell off everything. It's not there to help. It's there to help the West, the creditors, not the debtors.
Well, you know, Michael, you already made the case, and I had a question for you before. Now, what I was going to say is that some people make a case that in both Ukraine and in Greece, the IMF, in violation of its rules, has loaned money to countries that are bankrupt, cannot possibly pay. Now, first of all, I think I already know the answer because you already said this. Do you think that's true in the case of not just Ukraine, but also Greece? And if so, why is the IMF doing this in both cases?
Well, the IMF staff itself said that this is true. It's the 2013 annual meetings in Washington. You had them coming right out and saying that the IMF forecasts were a joke. The Wall Street Journal summarized a 50-page internal paper on Greece. And the Latin American directors came out and said, look, the IMF is just coming up with fictitious reports. And just last week, a number of Latin American directors of the IMF once again came out and said, look, its forecasts are just made on junk economics. So obviously what's happened is, a little beknown to the press, the IMF has actually moved its offices into the Pentagon with a branch office on Wall Street and is just doing whatever the U.S. tells it to.
So basically you're saying that there are political reasons for them to do this, even though they know full well that these countries can't repay in full.
Well, that's why the IMF was created, for political reasons.
Now, what is the situation in Greece at the moment from what you're seeing?
It's very bad because the Europeans are trying to make an object lesson of Greece. They worry that if Syriza manages to write down the debts that Greece owes, that all of a sudden this will enable Podemos in Spain, Italy, Portugal, and other countries to say, wait a minute, we can't pay our debts either. We've got to write them down. So they're trying to make Greece an object lesson and treat it pretty much like America would treat Cuba or Iran or North Korea. They're trying to absolutely crush it. They want to bring back the colonels. They want to bring back the right wing and say, you see, the left can't do anything. Bring back the right and start privatizing your property again.
Well, you know, obviously they could be successful in doing that because, you know, with QE in the midst here, we're also getting a dividend from the fact that oil prices are going so low. Clearly, they're going to be able to say in Spain, for instance, look, you guys, you've towed the line, therefore you're getting the benefit, don't vote for Podemos. Do you think that they're going to be successful in doing that?
Nobody can tell right now. I think that Varoufakis and also Jamie Galbraith, who's negotiating with them, are the best possible negotiators that they could have. I think they're doing everything that's reasonable. The question is how intransigent the Germans and the Europeans are going to be. Germany has set its sight on grabbing Greece's electrical system. It already owns 40% of the electrical utility. It set its sight on smashing Greece and buying out what it can in a smash and grab operation. And the question is, can this succeed, or can Varoufakis and Syriza find some way of going it alone, or will they be driven into going back to the drachma?
For the big deal. I'm sitting here with the one and only Ed Harrison, and we are talking about everything from Wall Street bonuses to GM's share buyback program. So without further ado, let's get started. Let's start with the bonuses, since I talked about that earlier. 2% raise, almost $173,000. I know you wish you were working on Wall Street now, even though I know you made out well back then. But what's the significance of this? What does this mean for the economy?
Yeah, so I mean, I think this segment we're calling it the top of the market question mark, because basically what it means is if you look at the chart for what Wall Street bonuses look like over the past 30 years from 1986, every single time there was a top of the market in terms of the market itself or in terms of Wall Street bonuses, you saw a collapse afterwards. So we're talking 87, we're talking 1994, we're talking 2000, and then again in 2007. That's when Wall Street was making the most money, and immediately after that, every single time we either had a market crash or we had some sort of recession. So that's what's happening right now, that we're escalating up to that level. You got to wonder, is this a contrary indicator for a top of the market?
Okay, well, what other signs besides that are telling us that the markets are at a cyclical high?
Well, you know, thinking back to last year, we saw a huge run-up in shares, and the NASDAQ in particular. Now, here's a chart for the second thing that I would like to point out, this is share buybacks. Now, you can see there are two humps there. The one hump is in the last cyclical upturn we had, and then there was a crash down in terms of shares, and then there was, it goes up. The green line is showing you where the S&P 500 is going. So basically what happens is these companies, they get in at the top of the market, buy as many shares as possible, buy high, sell low, when the market crashes, and do a terrible job. So whenever you see a huge amount of buybacks, basically what's happening is it's a waste of shareholder money. It's a sign that the market is topping and that you should be very leery. That's where we are right now.
Okay, so that leads into my next question about GM. As we know, they have a $5 billion share buyback program. Tell us about that. Why exactly would a company like GM, institute something like this?
Well, the reason that you have a buyback, just think about this. You make money as a person, and then you put your money in your bank account. GM does the exact same thing. They have a bank account. They can do various things with that money. They can go out and they can buy equipment. They can hire new workers. They could pay dividends. They could buy back shares. So when you buy back shares, what you're saying is of all the things that we could do with our money, this is the thing that we believe is a very prudent thing to do because our shares are undervalued. So they're basically saying buy our shares because we're buying them. And that's the message they're trying to send to the market.
Mm-hmm. And a lot of people would say that this indicates a healthy company. But some other people don't necessarily see it that way. The people that stand to gain the least, I guess you could say. Tell us about that.
Well, yeah, two things on that. Now, think about GM. From 1986 to 2002, GM bought back $20.4 billion in shares. And, of course, we all know they went bankrupt just a number of years afterwards.
And who bailed them out?
The taxpayer bailed them out. And not only did the taxpayer bail them out, but the UAW, the union, they took labor cut costs of about $11 billion, 21,000 layoffs, et cetera. So instead of rewarding these people, what they're doing is going out and buying back $5 billion more, thinking somehow that they're not going to run into trouble again, even though we have excess capacity in the auto sector globally. So to me, this is not a good use of money. When you combine it with the trends that we were talking about in terms of the top of the market, in terms of Wall Street compensation, share prices going up the 6th year in a row, it's not a good sign. It's a bad sign.
Bad sign. All right. Unfortunately, we've run out of time, but I'd like to pick up this conversation again. That's all for now, but we do love hearing from you. So please check us out on Facebook or get on Twitter and tweet at us, Aaron Aid, Edward NH, and Amira David. That's me. And as we close out here, make sure to take a look at the sneak peek of RT's newest show, Watching the Hawks. That launches on March 23rd. From all of us here at Boom Bust, thanks for watching. See you next time.
In the heart of the spotlight. Now I shine that spotlight back on them.
I could change your mind, because in a mad world, only bold make a difference.
Actions speak louder than words. And in a world where words mean nothing, I'm watching.